Hi, everyone. Thanks for joining us today. My name is Andrew Grant. I'm the Director of Manager Research and Investment Solutions here at Kayne Anderson Rudnick Wealth Advisors. Joined with me today is my colleague, Ben Falcone. Ben's a Managing Director and Client Portfolio Manager at Kayne Anderson Rudnick. Ben spends quite a bit of his time educating our institutional and retail clients about our Kayne-related proprietary strategies and how the market environment around it is related to your investments. So Ben really spends a lot of time with the portfolio managers who are overseeing the underlying positions in these strategies and helping to understand what the market environment is. Today, we'd like to go over a few topics with you. One being the current market environment that we're seeing right now, and really that we've seen since Liberation Day. It's been quite a wild ride. Second, the AI theme and how that relates to our proprietary strategies and third-party strategies as well. Third, a reminder about how the Kayne strategies and what our approach is from a quality perspective. We follow a disciplined, high-conviction approach, focusing on identifying what we feel are exceptional companies with durable business models, strong management teams, and the potential to compound earnings and value consistently over time. Thus, it's a process that's rooted in quality, patience, and deep fundamental research. And lastly, we'd love to talk to you about the near-term environment and the long-term opportunity sets within these strategies. Again, I'm very happy to have our colleague here, Ben Falcone. Ben's going to walk through some of the current market environment and strategies on the platform. And Ben, thank you again. We appreciate you being on today.
Great. Thanks, Andrew. And yes, clearly quality in what we do here at Kayne has been in the near term underperforming. So we're going to walk through that. We're going to talk about that. And really, I think the most helpful way is to put that initially in a historical context. And that begins here on this slide 3. And so we've seen periods when lower quality stocks have outperformed and quality companies have underperformed. And this usually happens during euphoric times or early on in market cycles when interest rates have started to come down after coming through a difficult time period like a recession. So we've seen this in the past, during where quality underperforms during the buildup to the internet bubble here in the late 1990s. We've seen it after coming out of the global financial crisis in 2009. We've seen it most recently, or what seems like most recently, but it was actually about 5 years removed, coming out of the first quarter from the pandemic. And that's when, we came through a very difficult time period, and a lot of artificial monetary and fiscal stimulus helped propel the market in the near term. Now, also, it's typical to see the reverse of that. When do quality stocks do well? Well, quality stocks typically do well during difficult times. So difficult times would be like when you're going through, a difficult time period, like when the internet bubble burst in the year 2000. Or like going through in 2008 during the global financial crisis. 2011 was during the European sovereign debt crisis. And then that first quarter of the pandemic, of course, when we thought that we were going to go into a pretty deep recession, even a depression. And so this year's been unique because we've had really both of these types of time periods. In the beginning of the year, we had a time period where it started with a day like the DeepSeek day early in the first quarter, where there was a fear of AI CapEx, which has really been, bolstering the market. If that, there was a day there where we thought we could start to see a slowdown in CapEx spending, and then it ended with a day in April, so about a 2-month period there, which was Liberation Day, where the implementation potentially of 100 to 200% tariffs. A lot of economists around the world were predicting a potential recession. And that's when quality outperformed. And then subsequently since that, We've seen a period where it's been really both things combining, a period of euphoria around AI related investments, as well as higher conviction in multiple interest rate cuts going forward. And so that's really what's led to this kind of underperformance of quality in the near term. And I'll just end this comment with a fairly astounding stat. As of September 30th, companies with betas above 2, so these are typically companies that are higher volatility, momentum, lower quality types of businesses, have outperformed companies with betas between 0.5 and 1, which tend to be less volatile than the market. It's typically where our Kayne strategies tend to average. The higher volatility stocks have outperformed the lower volatility ones by over 40% on a 12-month basis. And that's been quite a headwind for ourselves, our strategies, and quality investments.
Yeah, I think these extremes are just, they're very large, right? And a lot of what's happening, especially in the large cap space, this is not just a large cap phenomena, right? This is happening in large, this is happening in mid, this is happening in small, where quality types of names are underperforming, right? We saw a nice beginning to the year with quality this year in 2025. We saw outperformance of quality strategies when Liberation Day happened, right? And tariffs were announced. These were the types of names and strategies that were very strong from a relative performance basis. But like you just brought up, the skyrocketing of non-performers here, high beta names, high PE, companies that don't have very consistent earnings or proven business models yet, have really been at the forefront of this takeoff and trajectory that we're seeing in low quality stocks.
Yeah, I would agree. And this chart here, Andrew, does show that in small cap. This is the first chart was on the larger cap side. This is when you look at small cap indices and style indices in the small cap space. You can see this huge gap has opened up between momentum stocks that have done very well and quality stocks which have not.
Yeah, momentum has just been the driver this year, really, again, since Liberation Day, where you can see quality underperforming, low volatility, all the major factors are all underperforming. So it's really been this price appreciation and people hitching their wagons to the notion that all of these AI names are really just going to continue to move forward and higher and up and to the right without proven business models.
Yeah, and look, while these periods may seem cyclical, like when I spoke through the different periods when each one outperforms, when you look at over longer term time periods, we do believe quality investing clearly has a lot of merit. And so, in the nearer term, and this would be the S&P, when you look across different rolling time periods, if you look at a 3-month and a 6-month basis, quality is outperformed the broader market 55% and 60% of the time. So over 50%, but nearer term can be somewhat more random, I guess. When you look at this over the longer term periods, and this is really where I think the conviction in quality investing is greater. When you look out over a 3-year period, a rolling 5-year period, a 10-year period, you can see it's really over 3/4 the time to over 80%. Quality has outperformed in the past. And then when you look at this on a small cap basis, in the bottom chart here, which is very similar to the prior chart, but in the small cap space. And again, we're looking at Morningstar's small cap style indices, which came out in 2008. So when you compare quality versus the broader universe, again, you can see over the shorter term time periods can be more random. As you go out longer term, 3, 5, and 10, you really start to see, again, the merits of quality outperforming over 2/3, around 2/3 to over 90% when you get out to a 10-year period. And why do quality businesses tend to outperform over longer term time periods? Well, quality businesses, one of the great characteristics about them is the consistent compounding of value that you get year in and year out. It may not be the greatest in any one given year, but if you can consistently compound value greater, you're going to see bigger differences over the longer term. And it typically happens by not losing as much, if at all, during the difficult times, and then recovering value faster when times recover.
Yeah, quality names always have a tendency, from what we've seen historically, right, to really protect people's capital on the downside. That's really what that has shown us over time. I think these two charts were really interesting. One, this is not, again, not just a small cap phenomena. This is also a large cap phenomena. And it was interesting to see those even shorter term periods, those 3 and 6 month periods, where in large cap, quality is actually outperforming on the 6 month look back, right? So
Yeah.
I thought those were really interesting. And again, this is about the long term performance. This is about staying invested long. It's about time in the market versus timing the market that we have here. And I think that really leads us to trying to help people understand, how are earnings in these quality portfolios, right? I know that from talking to our third party managers who are seeing the same type of headwinds from high beta names, high PE, high debt type companies, that it's very hard to compete in this type of a market. But Ben, maybe you could give some people a general idea and perspective as to how earnings are doing in the Kayne related strategies.
Yeah. If we focus, and we'll focus a little bit more on our small core and our mid core strategies as two of our focal ones. But when you look across how companies, let's just start with how companies with earnings are doing, right? And there, on this chart here, you can see that year to date, companies without earnings are outperforming companies with earnings. And this is in the Russell 2000, where, look, companies without earnings represent about 40% of the companies in the index, a little bit over that, actually. And so it's a meaningful subset, and it's outperforming, by over 600 basis points. But what you can really see is that it's outperforming a lot since that early April time period. When we really saw, an increase in volatility coming out of that time period, and a lot of these kind of more momentum names outperform. So you can see over almost 24%, outperformance. And so, no earnings businesses really started outperforming. If you look, like going back to the second half of last year when we saw the first rate cut. And then we took a pause, as I mentioned earlier this year, when times got tough during a 2 month period there. And so we didn't see interest rate cuts. We saw a more difficult time period. And then after that, non-earners have been outperforming by a significant margin. Now, if you think about on a company level, where do you see some of the most egregious examples of these types of non-earning businesses? And I'll just bring up companies that people listening to this have probably heard of the types of business models where you've seen this type of outperforming, but it would be in businesses like quantum computing companies, or in power companies like fusion reaction or small modular nuclear reactor types of businesses, all because of the increased demand that we're going to need from a power side to meet the AI power demand going forward. In other spaces where you tend to see more momentum types of names, could be like in the financial space, even names with earnings, like companies with buy now, pay later apps tend to be doing very well, or speculative brokerage businesses with low account values. These are some of the market, really a lot of the market leadership areas. And so these companies are early stage businesses. They tend to be loss making. They're investing heavily in R&D. They're coming to market to fund themselves with secondary equity offerings. But they're trading at extremely high valuations. Most of these companies do not have earnings, and they're trading, above, hundreds of times price to sales. So it's really hard to wrap your head around, and for us to wrap our head around as long-term quality investors. Now, I'm not here to give an opinion on these types of businesses. They're all early stage, and they're doing what they probably should be doing in an early stage. It's just that the market is being really insensitive to their valuation. It's all momentum investing. It's investing in short-term market leadership with the belief that it will continue to lead the market, again, with disregard for valuation. Now, the other side of this, it's not just all these businesses are doing great or all these stocks are doing well, rather, and everything else is just flat. The other side is the way the market has really been punishing businesses that are dealing outside of this AI ecosystem, where it's not a lot of just conceptual, really, good news and all about the potential going forward. If you're in a business outside of AI, you're really dealing with moderate uncertainty due to tariffs or a lack of, full transparency around your business. And so you see growth moderating as businesses moderately tighten their CapEx or consumers pull back a little bit on spending. And you'll see companies that will, either, have a slower growth, or they'll have more moderate guidance going forward. Just to be more prudent, they'll issue lower guidance going forward. And there, the market is being really punishing as well. So that's really where this gap has opened up between earners and non-earners.
Yeah, that divergence is just amazing. And I think, this is a great segue as well when we're talking about non-earners versus earners, thinking about when this has happened in the past, right? I think a lot of people are very focused on large cap names. And if we're talking about AI and we're thinking about 1999 and the dot-com sort of era, there are some significant differences, right? There are absolutely large cap names that everyone's going to know and heard of that are doing well. Their cash flows are good. They're real businesses. Their core businesses are extremely solid. Now you mix in this AI sort of layering on top of that, and these hyperscalers, the money that they're putting to work. The companies that you were talking about, the non-earners, are really the ones that are making it much harder for all these other types of quality businesses to do well, even when their earnings are growing. Or if they do bring down guidance slightly, it's very little, but they still have earnings. So to put this into perspective for people, Ben, I think it would be good to go through timeframes where we have seen this before, and historically what has happened after, when we have some of these relative underperformance periods of quality type strategies. Can you walk us through that, please?
Yeah, for sure. So this would be, again, we'll look at our small cap core and our mid cap core strategies. And there have been time periods in the past when you look on a 1-year basis, like we're going through today. And you'll note that where you see these underperforming periods, are periods like 1999 and 2000. So leading up to the internet bubble, that strong performance of momentum, low quality businesses. 2004 would be, when we came out of the recession after the internet bubble burst, and 9/11, where interest rates were lowered. Again, another period, interest rates being lowered, coming out of a difficult time period where we saw that was one of the best performances of the Russell 2000 over the last 30 years. And then 2013 it would be coming after many years of quantitative easing and artificially keeping rates low. We saw an underperformance there. And then again after the pandemic, about a year after the pandemic. And so the point here is that in these time periods where you've seen this underperformance, if you look out over 1 year, 3 years, and 5 years after, the performance versus, and this is cumulative performance, not annual, just to be clear, but the performance is very attractive across these time periods, 1, 3, and 5 years. And we see a very similar outcome on the mid-cap core strategy as well. Going through a difficult period for 12 months. We have about 4 or 5 periods here, and then looking at how that performance has come outside of those periods after. And so the message here is, if you're a long-term quality investor, these are the types of periods where you can really augment your returns. And we all know this, right? Dollar cost averaging in difficult times leads to better results. And so this is one of those time periods where I think it might pay to sharpen your pencil a little bit.
Ben, that was great. Thank you for showing everybody how, and putting that into perspective really can help people understand where we are in today's market environment. I think it's important for people to understand that the difference that we're seeing between non-earners and earners is extremely divergent, right? We've seen this massive upshoot in names that have high PE, extremely highly valued, highly levered companies, everything that makes up a low quality type investment, right? We are seeing these massive extremes this year. So putting those market environment perspectives in place is great. The AI theme, as we discussed, it is a real technology. We are very much believers of that. What innings are we in, I think, is still to be seen. There will be companies that do well. There will be companies that just have a nice tailwind from that. And again, that's been very obvious from the earners versus non-earners discussion that we had earlier. Also, just a reminder, the Kayne investment approach and our third-party manager approach is very rooted in quality. We do have this time period that we're seeing where these non-earners and low-quality type names that do not have earnings are doing very well relative to the rest of the market. And lastly, putting this into perspective and where we've been before, as seeing that these near-term environments can provide very attractive long-term opportunities, as Ben just walked through. Again, we wanted to thank you all for your time today. We appreciate your trust and confidence with us here at Kayne Anderson Rudnick. If you have any questions, please feel free to reach out to your senior wealth advisor.